Hey, good morning, options traders. Well, recently I posted a video on a strategy called the Super Bull strategy. And normally, when I do a strategies video, I usually include the bull and bear version because, after all, they're virtually the same. One is generally built with calls and one is built with puts. So when you understand it in one direction, it's usually pretty easy to just flip it. And so I kind of made that assumption on the Super Bull. And naturally, I had somebody that emailed and said I didn't quite understand how you would actually construct a super bear strategy. Could you please elaborate? So here we are. What is a super bear strategy? As always, before we get started, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So the super bear strategy, just like the Super Bull, it is more commonly known as a three-way strategy. And for the bear version, you would normally construct it by buying a long vertical put spread. And so because you're buying it, it's a debit spread. And then you will also assist that strategy with the sale of a call to finance the vertical spread, or at least to offset the cost. So because that's the idea, is to get that vertical spread completely above zero, most of the time that means that you are going to be using an out of the money put spread and you will be selling an at the money, maybe even a slightly in the money call option. So if you're buying the put spread, you're going to be selling the call, just the opposite of the Super Bull. For the Super Bull, we were buying the call spread and selling the put. So for example, let's say that the stock is 100 and you buy the 90.95 vertical put spread. And let's just say it's trading for 90 cents. And then for the call, let's say that you sell the $100 call, perhaps trading for 350. So notice that we have three different strikes in order: 90, 95, 100. The lowest strikes, at least for the super bear strategy, will be the put spread, and then we're going to put a short call on top. So that's really the best way to visualize it. So in this instance, we have a net credit of 260. You're going to receive 350 from selling that call, and then you're going to spend 90 cents of that, which leaves you with a net of 260. So let's break them down independently. The sale of the $100 call for 350 would look like this. We've got this 350 gain right here for all stock prices below 100 at expiration. But the problem with this, like all naked options, is that we have unlimited upside. And this is also why it is called a super bear strategy, because you've got to be super bearish. You're willing to accept this unlimited upside risk. Now, once we overlay the 90.95 put spread on top, that's going to look like this by itself. There's our short 90 put, there's our long 95. So again, normally if we buy the 90.95 put spread, we own the higher strike put. Stock is falling this way, we start making money, and then if the stock hits 90 or below, we are completely capped out. So that is the purchase of the 90.95 put spread in blue. Now the main reason for selling this call out here, this naked call, is to get this part of the blue line for all stock prices above 95, to get that above zero. See, anytime that you do a vertical spread by itself, part of it will be above zero, above this zero line right here, and part of it will be below. It has to be, otherwise it would be an arbitrage. So what you're trying to do, one of the goals is to get the entire bear spread above zero. So you're trying to shift that part up. So this is also a little bit of an insight why most of the time you will be selling, let's call it an at the money call, and then maybe buying an out of the money put spread, because you're trying to generate a credit larger than the cost of the spread. So if this is our stock price right here, the current stock price, we need the stock to fall, but always remember we have this unlimited upside. So again, that's another reason that it is a super bearish strategy. So if we were to put these two positions on in the account, the one in red and the one in blue, in other words, buy the put spread and sell the 100 call, we would get this. And that is the overall risk profile, at least at expiration, for the super bear. So as I just talked about, you can see that this part between 95 and 100 sits above zero. And that's, again, the main reason for selling off this call. is to try to get the entire vertical spread above zero. So just like with the super bull strategy that I mentioned, it's kind of a misnomer, at least to me, because if you're super bearish, you have to ask, why would you limit the downside? Wouldn't you want that to be unlimited if you are super bearish? So I guess it does depend on the perspective. What they're saying is that if you are super bearish, then you should be willing to assume this unlimited upside risk up this way. So that's sometimes why it becomes confusing for new traders. They say, well, if you're super bearish, you should have unlimited downside ability, and you simply don't. Instead, you are accepting unlimited upside risk in order to get that bear spread completely above zero. So now that we've seen the super bear strategy in more detail, if you compare it to the super bull, it's just the opposite. This is a super bull in green, this is a super bear in red. Just mirror images of each other. Now, why you would choose a super bull or a super bear could be among a number of different reasons, but we'll have to save those for future videos. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.